Cool. All right, so thank you guys for coming in. Thank you for watching this. So the intent of this presentation is we find a lot of times when Mudo, myself, are talking to clients, whether they're first-time buyers, second-time buyers, and even sellers, we're seeing some fundamental things that are being wrong. So the intent of this is to educate, really share with you guys what we've seen, share the lessons that we've learned, what we hear other clients are going through, so that you can perform great in this tough market that we're in. If you're a buyer or a seller, it's really tough on both sides, and we're going to go over that. One thing that we're intending to do as well is towards the end, we're going to talk about what is happening in the marketplace in terms of sales. We're going to be talking about.
Sorry, I think I'll unmute.
Perfect, yeah. So one thing I'll do as well is I'll just make sure everybody is muted, and then we'll go from there.
Okay, excellent. So I think I muted everyone. So
there you go. So yeah, the intent of this again is not just for first-time buyers. This is what we're talking to anybody who is a seller, second-time buyers. We're still seeing things that are being fundamentally wrong, and unfortunately, in this marketplace, things are not very forgiving. It is, the prices are a little bit on the higher side. We're seeing that the affordability is very challenging. We've seen unaffordability in our marketplace in the GTA for close to a decade now. So this is where we try to educate all our peers here, all our friends here, and we'll get started. Anybody has any questions, put it on the chat. We will leave about 10-15 minutes towards the end to answer your questions directly. Let's dive right in. So the quick little agenda here, we're going to talk about ourselves quickly, just explain who we are. Where do you start as a first-time home buyer? Where do you start? This part here is very important if you are somebody that's not a homeowner or hasn't been in the market for a while. This is very key and important. And then tips to get you started. We want to kind of talk about what are some simple things you can do today, even if you're going to buy a home in the next year or two. A lot of times people come to us when they think they're ready to buy right away. Hey, let's go look at homes. Let's go start viewing homes. It's actually not what we recommend. That is not the best way. Talk to us as early as 2 years. Then last, we're going to give you the market updates. A lot of big changes have happened in the mortgage world. So glad to have here Mudo from Mudo Mortgages to support us. And of course, these are your questions. So put them in the chat and we'll go answer them. So Mudo, do you want to introduce yourself there?
Yeah, sure. So my name is Mohammed Mahmoud, aka Mudo. So I've been a mortgage agent for over 4 years now. I work with Dominion Lending Centers. So my job is basically to find the right product, which is basically the right mortgage for clients, depending on their situation, and finding the right bank or the right lender for them.
Excellent. And the reason why I have a mortgage broker here with us in this call is simply because a lot of people think going to the bank is the only option, is the best option. It's not true. Mudo is like a mortgage broker. He is capable of getting you a lender mortgage. So from all the banks that we have, majority of the banks do work with them, as well as secondary options as well, looking at B lenders or credit unions, which can also have some really good favorable rates, or depending if you're self-employed, can be very favorable. So that's one misconception that I want to kind of clear out of the way right now is a mortgage broker usually doesn't even cost you anything and can give you access to a lot more lending options. Just last week, you managed to get a 0.3% discount for one of my clients just simply by them reaching out to you. So very important, talk to a mortgage broker as early as possible. Myself, Mohammed Ali, I'm a realtor, engineer turned realtor, been a real estate agent for a little over 9 years. Full-time for nearly 3 years. We put our handles there, whether it's YouTube, Instagram, whatever. We like to post a lot of educational content to keep you guys as informed as possible. Let's get moving. Again, for the people that joined, anybody that has any questions, put them in the chat below. One thing that's very important, we want to kind of focus on this, is privacy disclaimer. The reason for that is, unfortunately, a lot of people think when they talk to us about finance, which is a very sensitive topic, first thing we're going to do is go make some shy and start talking to our friends about your personal finance. That's not what we do. We never like to share any of that kind of stuff. It's our professional conduct that's our higher standard that we want to maintain here. So anything we talk about, if you have anything sensitive, maybe don't put it on this chat. Talk to us privately one-on-one. We'd love to hear and support and help any way we can.
Yeah, if you feel that there's something that you don't feel comfortable sharing that's private, feel free after the session is over, just call us or directly email or text us and we'll be happy to help.
Excellent. So We're going to talk a lot about personal finance for the first like 10 minutes. This is important for everybody. This is not just for first-time buyers. The reason for that is the average Canadian has $4,200 in credit card debt, right? That's right, the 19% credit card annualized interest rate, people are carrying about $4,200. And I would love to have looks like the majority of people here are Sudanese, love to have my circle of folks, whoever it might be, to have zero. But unfortunately, I have seen a lot of credit reports, I have seen a lot of people's finances, and it does hover around that average. So that's one thing I want to make sure we can one of the key takeaways from this presentation is check your credit card balances. Don't hide from your credit and try to bring that credit card balance down to zero. And people's total credit, so that includes student loans, includes car payments, all that, lines of credit, is $21,000. So let's please try not to make the banks any more money.
Exactly. I think it's an important message to get across because it affects you in multiple ways. Like one of all, it makes you you're not able to save as much to to put towards your future down payment on a home. And another thing that affects you is it also affects your credit score. So even if you're making the minimum payment on your credit card each month, but your utilization is going up each month as you do that, and that affects your credit score, which in turn affects your ability to potentially buy a home in the future, get a mortgage, or even other loans that you might need.
Excellent. The question is, where do I start? I'm somebody right now, I have some cash, got a decent job. Where do I start to make sure that I'm ready to purchase the home? It starts with your credit. It's a pretty good segue, actually, from what Mudo was saying, is a lot of folks that come to us. I've seen balances on people with $150,000 down payment, even more, actually. And when they come to us with a great job, six-figure job, great down payment, they think they're ready to go. They can buy any property they want. And we go open up the credit report, and it is a disaster. Not only is it a disaster from the score, but the amount of debts they're carrying and the types of debts they're carrying are affecting their score a lot. So there's a couple of free sources here, whether it's Equifax, TransUnion. Please, guys, one common mistake that we see people do is you're using the bank app. The bank app is not a true score. I've seen some deviations from that, and I've seen people think they have great credit because they're using the bank app, and they ignore using these credit unions here, or credit bureaus, rather. Did you want to add anything?
Yeah, correct. And I would say credit is important, not just for if you're a new home, first-time home buyer, but if you already own a home or even own a couple of homes. I know some people on the call might not just be first-time home buyers. This also is important because you did get the mortgage, for instance, but your mortgage does renew every 3 or 5 years. So when the time comes to renew your mortgage, if your credit is in a good situation, you have good credit, it gives you more options to negotiate with your existing lender or even change your existing lender or bank if you don't like what they offer and go to a different bank. So credit still plays a factor even after the fact that you bought your home. It will always play a factor. So it's always important to stay on top of it, even if you have been through the first phase of buying a home.
Perfect. So interestingly enough, a lot of people think paying their credit card bill on time is enough. One important thing that we want to talk about is there's actually 5 factors that affect your credit. Now, the one that everybody talks about is the bill payment, which is good. It's a good one. It's pretty much the majority. But the other 65% is actually other factors completely that has nothing to do with paying your bill on time. And that's why if you pay your bill on time, you can still find your credit score to be significantly low. The one that we want to focus on just for today, just so we're not throwing too much information at you, is amounts owed. So that's the balances on your credit. We like to, a good rule of thumb in the industry is 30% of your credit, sorry, what is it? Keep your balance under 30% of your credit limit, because that affects 30% of your credit score. So 30% of your limit. So if you have a $1,000 credit card, you should not really be spending more than $300 on a cycle. And that's how significant it is. So if you find generally you're spending $2 or $3 grand, then maybe raise your credit limit to about $5 grand, and then you'll be closer to that 30% threshold.
Yeah, this is the most common one that people are affected by, especially people that pay their bills on time. They have a good length of credit history. Their credit has been open for like 10 years or something. They don't apply for a lot of new credit. but still they find that their score is lower than the average Canadian. And the reason most of the time, 99% of the time, is because of their credit utilization. Although they're paying it off every single month, but their balances are high in comparison to their limit. So if, like Muhammad said, if they have a 10,000 limit on their credit card, they're using more than 3,000, which is not advisable. So sometimes they're using 5,000, 7,000, and it does bring down your credit significantly. Um, I've seen people that had over 800 credit scores, and just for 1 month they had a high balance. Their score immediately went down to like 780, 760, just from 1 month of increasing their utilization. So that's something to always try to keep track of, to make sure that you don't lose, especially at a critical time when you want to apply for a loan, whether it's a car or even a mortgage.
Perfect. Speaking of that, actually, applying for Equifax or TransUnion to check your credit, people are worried, oh, I don't want to affect my score. It might lower it by just a few points temporarily, and it's better for you to check it than to go and wait for someone like us to do a credit pull on your file. There's nothing wrong with these. It just is something called a soft pull. And sure, it might drop it by 2 or 3 points on the time off. I'm not even sure if it does if you do it yourself. But even if it does, it goes right back up within a few months.
Yeah, if you do it, it's a soft check, so it doesn't affect you no matter how many times you do it, as long as you're the one that's doing it for your own self.
Perfect. And one last one while we're here anyways is, if you have a really, really old credit card that you don't use, just keep it. I'll share with you why, because it affects 15% of your credit score. So just keep it. If it's a really old credit card and it might be one of the oldest ones on your file, just leave it. It affects 15% of your credit score. Nothing's wrong with keeping it for now. Just make sure you're spending it wisely. Let's keep it moving, because there's other things that are important for being prepared, which is your savings. One thing we've seen, and again, this presentation stemmed out of the conversations we're having with individuals. I love that our community, I love that people are saving money. I love that. The issue we're finding is they're not utilizing the tools that are given for you, especially if you're a first-time home buyer. Now, again, it's not tailored to just first-time buyers, because this could be beneficial, like I said, for other individuals as well. But the RRSP is not just intended for retirement. It does have the opportunity to, can be used for a first-time home buyer. You can pull out up to $60,000. Or if you're doing a master's or lifelong learning, you can also pull out your RSP. A new account that was added last year is First Home Savings Account. So those two is where your money should be, not just in a general TFSA account or a savings account. So let's dive into each of those accounts in more detail and explain what some of the advantages that come with these accounts. Do you want to dive in?
Yeah, sure. So these, like Muhammad mentioned, these two accounts are very important, especially for a first-time home buyer. So we have the FHSA, which is a new account that came out last year, First Home Savings Account, and everybody knows the RSP, the Registered Retirement Savings Plan. So how these two can help you is, if you have savings that you want to put towards your down payment, I would advise that you start with these two accounts. So you start with the FHSA, where you can put up to 8,000 per year to a maximum of 40,000 total. And what that does is, number one, it reduces your tax burden. So at the end of the year, when you come and pay your taxes, it will deduct from your taxable income. So you're actually saving on your taxes, and you can pull it out towards your first home, towards your down payment, without being penalized on it. Similarly, the Registered Retirement Savings Plan, you can put up to 60,000, depending on whatever limit they allow you. And it also helps with your tax deductions. Usually when you pull out money from your RSP for any other reason, you're penalized on it and you're taxed on it. But if you pull it towards your first home, you won't be penalized on it, as long as you've had that money in your account for at least 90 days, which is an important distinction between these two accounts. For the FHSA, you can put the money today, pull it out in a couple of days, and use it towards your first home. That's fine. For the RSP, it needs to stay there for at least 90 days. So if you're planning to buy a home within this year or the next year, make sure that it stayed there for at least 90 days before you pull it out, so you're not penalized on it. Another difference is, with the RSP, you do need to pay back that amount over 15 years, starting after 5 years. It used to be 2 years, now it's 5 years. So basically you have 20 years to pay it back, which is basically nothing if you're thinking about maximizing to 60,000. Paying it off over 20 years is not a lot of money. Worst case scenario, if you don't pay it off, you're just taxed on the small portion that you didn't pay back during that year. So it's a great plan for people. It saves money for it, helps you save towards your down payment. I see a lot of people that have money just sitting around in their savings. It's doing nothing for them. Whereas here you can save a lot of money.
Excellent. The reason why we have this slide here, this is so important. These two slides, if you're a first-time buyer, can literally save you tens of thousands of dollars in taxes. Let's break it down. I'm not sure if I ended up putting a breakdown of this, but here's literally what it looks like, okay? Cost of not using the RRSP. Because a lot of people don't understand what we mean when we say this can be very beneficial. Okay, so let's take it down. Let's say you make $100,000. Both aspects, this is without the RRSP contribution. This is with the RRSP, sorry, and FHSA contribution. So 60,000 plus 8,000, okay? If somebody makes 100,000, doesn't use it, taxable income is all 100,000. Let's just say roughly it's 30% tax bracket. This is the estimated tax you're paying. This is literally the tax you're going to give to the government. But let's say you wanted to utilize this program. Let's say by this year, let's say early next year, you set a goal for yourself, you want to purchase a home. So remember, this is not something you're going to reap right away. You're going to notice it next year when you're either getting a tax break, or you can start reducing paying your taxes from now. So $100,000, you contribute $60,000 towards the RRSP. Again, you do want to check what your RRSP contribution room is. It's a very simple CRA login. You log in and you scroll down and you'll see your TFSA contribution and you'll see your RRSP contribution. For most people that have been working for like 7-8 years, you probably are not in this range anyway. So, but just to check that, okay, on CRA login.ca. FHSA every year, so you have to open the account this year, and then you can only put 8,000. If you were to open it last year, you would have been able to put an extra 8,000, so 16,000. But let's say you only put 8. Now your taxable income is at 32,000. Now your bracket is a lot lower than 30%. But let's just keep it. Let's just say your bracket is the same at 30%. Your estimated tax you're paying is 9,600. So you've saved about 20 grand just by utilizing this. And here's the interesting thing: if you said, you know what, I'm going to keep it for the next home, you don't use it, you lose it. So it doesn't matter. You can't say, okay, this is a small condo, I can just buy it. Later on, when I get the big house, I'll use it. No, it's not how it works. It's intended for first-time home buyers. So you use it. Don't say, I'm going to wait until my income's really high, then I'm going to just use it.
Use it. Yeah.
Getting into the market is
another
so
thing
hard.
is worth mentioning is this is per individual. So if you're married, this is 60,000 in RSP per spouse. So that's 120,000 combined. And for the FHSA, it's the same thing. It's 8,000 per spouse. So that's 40,000 in total per spouse. So that's 80,000. So combined total of 200,000 between married couple that can be used. And imagine how much you can save just using this approach here.
Yeah. If you're wondering where the 40,000 came from, guys, so remember it's $8,000 per year. I guess we forgot to put that here. $8,000 per year per person, right? So you have up to 5 years, and this account maxes out. So this is actually so much forward thinking that even if you want to buy a home in 2 years, 3 years, even 5 years, there's nothing wrong with opening the FHSA account. The money should go here first. You get all the benefits of the taxes now without having to commit to maybe even making a purchase now or anything like that. So it's both of them can be very beneficial. It's not about buying today. It's about being prepared to buy when the right time comes. Each person is different.
Exactly. And for those of you who don't know, these funds that you have in your RSP or FHSA, you can still use it to invest. So if you're someone that has your money sitting, for instance, in a TFSA, or you're thinking, what is this money going to do just sitting for 5 years? If you want, and you're the type of person that's well versed in the stock market and whatnot, you can still use that to invest in whatever mutual funds or stocks to have it grow for you. And for the FHSA, it's similar to the TFSA, where any gains that you have in your stocks are not taxed, so they're tax-free as well.
Yeah. All right. So how in the heck, spelled heck wrong, am I supposed to buy a home? Okay, we totally get it. The reason why we want to add the slide here is for anybody that is a first-time home buyer here, even if they're a couple and they're trying to get into the market and they're like, what's going on? You have great jobs, you have great credit. It's a struggle. We share that, right? We understand it is very, very challenging, and we just want to sympathize with you that we get that we have an affordability crisis here, and it's been like this for pretty much half the time I've been in real estate agent. Like the last 4 or 5 years, I've seen it's been like this. It is a dual income city. The GTA essentially has been a dual income. Your dream home is not going to be your first home. I think a lot of people come in with the intent of trying to buy their forever home as a first home. It's just not going to happen. It has been difficult to do that for at least the last 15 years. Ever since I started real estate, you can never do that. You always would have started with some sort of condo or townhouse. At that time, you could have started with a townhouse. Now it's very common to start with a condo. And if it doesn't fit your family, it's okay. Rent it out. Rent prices, as some here might know, it's crazy high, and it's still high. Yes, rent has cooled down a little bit, but it's nowhere near where it needs to be. So you can be now a landlord and start actually earning some money.
And we have examples of people that were, they started small, bought a small condo, and then in a couple of years, they were able to either sell it or refinance and pull money out of it to purchase a larger home. So it's common to see a condo and then they purchase a townhouse or even a detached afterwards. So that condo is actually helping you save as well, instead of you just saving on your own.
Absolutely. So we talked about some changes that happen in the market. So let's dive in and look at what some of these look like. Muda, if you want to help us out here with this one for the mortgage rules that literally came out just a few weeks ago.
Exactly. So yeah, the mortgage world has been seeing a lot of changes recently. They are small changes, but they will add up over time. So 1 year rule is that for first-time homebuyers specifically, in the past, if you were to put less than 20% down payment, then the maximum home purchase you can get was just under 1 million. Now, government thankfully realized that this is not realistic, especially in this market, the Toronto market. So they increased the ability to up to 1.5 million, so a house price of 1.5 million, and you can still put less than 20% down payment. So it doesn't need to be a 20% down payment anymore. In the past, the moment you hit 1 million, you had to put at least 20%, which is 200,000. Another thing they introduced is if you're buying, if you're putting less than 20% down payment, in the past, you were limited to 25 years for the life of your mortgage, what we call amortization. But now they increased it to 30 years. And you would ask, why would I increase it to another 5 years to 30 years? It's because it actually helps your monthly payments. So it helps your monthly payments, number one, because they're spread out over more years. So it might be more affordable to you in terms of cash flow. And the other thing is that increases your affordability. So this is what we'll talk about here. So before, when you had only 25 years for your mortgage, if you were making 100K annually, then your maximum mortgage amount would have been around 415,000. Now that they've increased it to 30 years, it went up around 7% to 445,000. Now, again, you might say it's not a huge change, but it does help, especially those of you that are on the margins and just need that extra 40, 50, 60,000 to get into the market. The same thing with if you're making a household income of 150,000. Before it was around 658. Now it's closer to just over 700,000. And again, here with 175,000, it was 795 before. Now the qualification went up to 850,000. Now keep in mind that this is just the mortgage amount. We haven't factored in the down payment here. So you would add whatever down payment is. So let's say in the 850,000 mortgage, if you were putting 20% down payment, then the house price would be just over 1 million. So again, 6%, 7% might not seem a huge change, but it still helps a portion of home buyers, especially first-time home buyers, that need just that extra push to get into the market or become more competitive.
Of course, with that comes actually one more set of one more set of changes. This one happened actually yesterday. We literally added the slide earlier today.
Yeah.
Go for it.
Yeah, so I know you're a big fan of this one. So what happened here is we have a refinance, which for those of you who don't know what a refinance is basically you're able to borrow more equity from your home and use it towards different projects. Now, the maximum used to be 80%. So let's say you had a $1 million home, you are allowed to borrow up to 80% of that home, which is 800,000. And you, provided, of course, that you pay off your existing mortgage, and whatever is left, you can use that towards different investments or even savings or innovations or whatnot. The new rule that came out is they've increased it to 90% of your home value. So now you have access to more equity, provided that you use it towards building what's called a secondary suite. So that secondary suite could be a basement, for example, a self-contained basement, or it could even be a garden suite. So if you have a backyard, it has enough space, you can actually build on it self-contained suites, for instance, that have separate kitchens, washroom, and whatnot, and you can rent it out and have it produce income for you and help you with your monthly cash flow. And you can actually do up to 4 of these. So usually when you want to do a project that's this big, nobody has the cash lying around to do this, but now you're actually able to access the equity in your home and use it towards that project. And the interesting thing, it's not 90% of the home value today, it's 90% of the value after you add these projects. So after you do, if it's renovations or adding a secondary suite, the as improved value, like after you finish all these projects, is what you're able to access. So and the other thing is it's all also insured. So in the past, whenever you do a refinance, you lose the ability to have an insured mortgage. And what insured means basically is because it's insured, it's less risk, so you have access to better rates. So now you can actually do a refinance, you have access to better rates, and it's also spread over 30 years. So the cash flow is also kind of affordable.
Excellent. Now, of course, you're probably wondering, you can go into more debt, buy a bigger home or a more expensive home, and you can hold a mortgage for a lot longer. This is something that we're going to emphasize, use with caution. So let's go back quickly, just kind of go over a quick summary here, right? Yes, you can buy a home now up to 1.5 million, have a 30-year mortgage without having to put more than 10% down payment. Before it was 20%. Yes, you can refinance your current home, right? Instead of 80% of the home value, you can go 90% of the home value. You can have 30-year amortization, or extend that time period. But again, all of these it's debt. We want to share with you guys, if you're going to use something like this, where you're going from a 25-year mortgage to a 30-year, and you're doing it so you can get a little bit more boost, just so you can afford the home, just get into it. Once you're there, once you get a mortgage, a lot of people think paying the mortgage payments is enough. You can actually pay more. You can double up your payments. You can pay lump sum payments along the way, and that will really reduce your amortization. The goal is, once you get into the home, try to pay it down as soon as you can, or a little bit more aggressively, just so you have a bit more cushion and a little bit more ease, and you're paying a lot less interest in the long run. Okay, so these are tools that can help you. We're not necessarily encouraging you to go for your absolute max. If this is what you qualify for, push for this and really squeeze it. No, don't do that. Go for what you can comfortably. Mudo's job is to get you approved for the best rate possible, for the best mortgage you can get. It's up to you to stay within that. All right. So this is what we mean by just use it with caution. So let's dive in. One quick slide. I don't want to spend too much time on this, but unfortunately, a lot of people that when we have conversations with them say, I don't want to get a condo. It has maintenance fees. I absolutely don't want to get that. So I just did a little comparison here for you guys. This is exactly like true builds of what people see when they go into a condo versus, let's say, a semi-detached house or like a freehold townhouse or something. Condo fee, $600, nothing here. Everybody stops and says, yep, that's why I prefer freehold. Well, let's go with it, right? Utilities can include water, heat, garbage. These are included with condos. With a house or a semi-detached house, you have to pay those. Hydro, typically it's less for a condo, absolutely. So it's a little bit more for the home. Repairs and upkeep. You should budget at least $100, $200 here and there for your condo, just for a little upgrade, things that kind of happen. So about $1,000 to $2,000 a year, just for like minor repairs. For a home, it's a lot more than that, right? It's about $600 a month that you should be putting aside. And the reason for that is there's a lot of stuff to do that a lot of people don't realize. You're dealing with the interior and the exterior. So you're dealing with everything regarding gutters, roof, windows. Some months you're not going to spend this much, of course. But then once in a while you have to change a roof. Every 10, 15 years, you might address the furnace. You might address the AC, garden, cutting the lawn. And if it's not necessarily a cost, it is time. So there is that sweat equity there. That's you putting in more in a home. So you typically find that you're spending more in a home, which might be fine because you're getting maybe more space. But just keep that in mind. Condo fees are there for a reason, right? And the second biggest kind of misconception that we see is the cost of waiting. I want to kind of share this with you because it's a really interesting time we're in right now. We are seeing rates come down, but yet the prices have yet to jump. And we're going to dive into it a little bit more detail shortly, okay? But if you take a typical home of $750 with standard down payment, minimum down payment, you do have to pay CMHC. If the rate is at 5%, here's the monthly payments you're paying, the interest over the 3 years, and how much of the principal you've paid down. So one key number you should look at, and you can see this in a lot of the mortgage calculators, is what is your balance at the end of the term. All right, this is a very important number. Now, if you decide to wait and just keep waiting, let's say it's 4% rates, let's say it even gets lower, you absolutely do save on the interest. There's no doubt about that. But typically what happens with lower rates, and we saw this with COVID, is we see prices start to increase. It's a lagging factor, it takes some time, but we see prices start to increase. So you wanna be careful not to just say, I'm gonna keep waiting, I'm gonna keep waiting, keep waiting. What happens is once prices start picking up, you not only are dealing with more competition, so you might not be able to find the right home because you're constantly competing and stuff like that, but you're also gonna be paying potentially a higher purchase price. So here's what it looks like if you have a lower rate, but a higher price point. Absolutely, your monthly payments look better. It's about $166 better. Your interest you paid is a whole lot better. It's about $16,000, $17,000 less. The principal paid, you paid even the home more, but because you spent way more in the purchase price, your overall difference is $30,000. So sure, you saved $20,000 up here, but you spent 50 grand in the purchase price. Now it's a hypothetical, of course, but just keep that in mind that there is a cost to waiting. We don't necessarily mean 2 or 3 months here. We could mean 6 months, year, 2 years. That's what we mean. Buy when you're ready.
Keep in mind that the numbers that we have for the rate here are older numbers. So today it'll be closer to like 4% today. And then if you wait, let's say for rates to go down further, we'd say 3%. But the concept that Muhammad is explaining is still the same. You can wait for lower rates, but then you would expect higher price points for your house.
Perfect. So make sure you're talking to the right people as early as possible. Talk to Mudo or any mortgage broker. Talk to myself, real estate agent. Talk to a financial advisor. We have some great financial advisors in our community. If you guys have any questions, need any support with that, we can share with you guys the contacts afterwards. And for the people that are married, talk to the boss.
There you go, boss.
So we want to leave you guys with some homework for today. We're not done, obviously. Just kind of like a quick little summary, quick little break here. Make sure you're checking your credit. That's number one. Key takeaway. Sign up for the newsletter, so you will see an email coming in. We already have your emails. You can see an email once a month come in. That's a monthly newsletter that we send out from each of us. And what it does is it just shares with you what's going on in the market, so you stay up to date. If you haven't already, follow both of us. We keep giving you guys more insights as they come with the market, so it keeps you guys informed. Even if buying or selling is down the road, at least you're informed along the way. Your homework for the week, okay? This was your homework for today. Right away, you can start these. But your homework for the week is very important. Open up an FHSA account. If you don't open it this year finishes, you will lose literally $8,000 in contribution rule this year, okay, that you could have earned this year. So open it as early as possible. If you're thinking of buying a home, let's say in 4 years or 5 years, then you can at least maximize it as much as possible. If you don't use it this year, you can't go back and say, well, can we go back and top up last year's, you can't do that. So just keep that in mind. And then open up, transfer your funds. Don't put it in a savings account. Put it in an RRSP, but just check what your contribution limit is on the CRA website. All right? There's some personal finance stuff that just cleared out of the way. Let's dive into what is going on in our market. So Mudo, you can take over here, and I'll take over afterwards with the housing market itself.
Yeah, so we've been seeing good news on the inflation front specifically. The Bank of Canada did reach its target actually of 2% in their last announcement, which is part of the reason why we're seeing all of these rates going down and some rules are easing up on the mortgage front. So that's why we're expecting even more announcements for rates to come down. We've seen almost 3 or 4 rate cuts so far. We've also seen in the US, they've had a jumbo rate cut of 0.5%. So it all seems to be heading in that direction. Unemployment, however, is still up. It's closer to 6.6%, which is part of the reason why the Bank of Canada is starting to cut rates as well to stimulate the market. So the next Bank of Canada announcement is on October 23rd. There's another one in December, and they are still expecting rate cuts to come for the next year and maybe even the year after.
Excellent. If you're wondering where the exact rates look like.
Yeah, so variable rates are what's affected direct. So we have fixed rates and variable rates. So variable rates are what's affected by the Bank of Canada's announcement. So the latest announcement was September 4th. They did have a 0.25% rate cut, which was a third rate cut in 4 years. The prime rate, which is what the variable rate is tied to, and it's the rate that is tied to your variable rate if you apply for a mortgage, and even other types of lines of credit, car loans, they're all tied to this 6.45% rate. So now that doesn't mean that your rate is going to be 6.45%. It's usually that number minus a certain number. So variable rates today are actually hovering in the range of 5.3 to 6%. So they're actually coming down. We've seen rates that were closer to 7% at their peak, and now they're coming down gradually. They're still not as low as fixed rates. If you look at 5-year fixed rates, which are usually the lower, we're seeing as low as 4.11% today and maybe 4.61 on the higher end. 3-year fixed rates, which is what most clients are choosing these days because it makes more sense since we are expecting more rate cuts to come. So it might not make sense for you to lock in a 5-year as opposed to a 3-year. It might be a little bit higher, 4.39%, but you know that you're potentially going to renew into a lower rate after 3 years.
Excellent. Yeah, we have seen 3 rate cut announcements so far of 0.25. If you're wondering where rates are going, they are going to be trending down for essentially main reason is unemployment. Bank of Canada cares about 2 aspects. Cares about inflation and cares about unemployment. So those are the 2 factors. Inflation is hovering where it needs to be. It's at the 2% mark. But unemployment, ideally, you want to get to the 4 or 5% mark. So seeing that it's at 6.6 and increasing, and people that have stopped applying are actually not in the stat as well. So it's actually a little bit higher. This is the reason why you're seeing the rates are coming down and more likely to come down further as we go into this year and early next year. Okay. So I'm going to dive in here and kind of just explain to you guys some of the MLS market trends that we're seeing. Typically, a lot of people talk about this last year to this year, what's changed. I don't like that. And the reason for that is we came out of COVID. We came out of a very abnormal time where we saw homes selling within a week. You probably have seen it. You see a for sale sign come up. The next week you see, oh, sold above asking, and then it's gone. It's not how real estate is. It takes 45 to even 60 days sometimes to sell a home. It's very normal. A home sells in 45 days. That's not bad. That's not alarming. It's common. It could happen 45 days. If you've done the right things for your home, you've done, like nowadays, it's a little bit more challenging to sell a home. You do have to spend more time in the marketing, in the prep work, even sometimes renovations. It really depends on a case-by-case basis because simply, and we're going to look at the data right now, that homes don't sell off the shelf like they used to. So I wanted to put a snapshot of pre-COVID, everything, the last 10, 15 years, so you get a really good sense of what is happening in the marketplace. 2 big dips that you're seeing right now. Stress test was introduced. around late 2016. And with it came, so here's what you're seeing. The orange line is the sales trend, and the blue line is the sales at the time. So here's when they added the stress test, and we saw a big decline, which typically you see declines all the time because that's spring market and then summer and fall market, and then they added the stress test and it goes down, but it wasn't going back up. It kept going down, and that's what you're seeing over here. This is the stress test. Let's fast forward a little bit towards what's going on here. We had really low interest rates, This is COVID time. And then we had the craziness that you saw. This is when like you can buy a home, and the year after it went up by 20%. We're gonna look at the numbers there. It was just ridiculous. Again, abnormal time. We saw it come down, and then they started raising rates. We saw it come down further, right? And that's what we started to see when they added rates. It started coming down. So our sales activity now is actually at we're not actually at 2024. If you look here, this hasn't really updated, but 2024 has been really slow, which has been really positive for a lot of the clients I work with, which are a lot of first-time home buyers, because there's a lot less competition coming into the marketplace. Yes, the interest rates were getting hiked. Now, just recently, we started seeing them come down, and with the trend of coming down even further, but the sales activity has not picked up just yet. So you're wondering, why is that the case? Why is it that we're seeing interest rates have started coming down, but the sales activity has not increased fully? Let's see if this will let me zoom in. But there's 3 lines here. I know there's a lot going on here, but bear with me, okay? We're gonna try to break it down. There's something called sales to new listing ratio. This is a very important ratio. I kind of explained what it means up here. If it's over 60%, then it's a seller's market. If it's 40 to 60%, it's a balanced market. And if it's under 40%, it's a buyer's market. So sales to listing ratio. Sales is what home actually transacted. And the denominator, it's new listings. So if you have 100 listings come to the market, but only 50% of them sell, that's a 50% ratio, sales to new listing ratio, which means it's a balanced market. If a lot of listings come to the market, but majority of them are not selling, that's great. That's great news for the buyers. That means there's a lot of inventory they can work with. So here's something I want to share with you. We have been in a seller's market for pretty much the last 10 years. Okay? And I can safely say that because I know when I was working with some first-time buyers, we kind of struggled all the time. Now, there has been times where it's been a little bit more favorable, but the average overall has been close to 70%. I think this number is a little bit higher. It should be closer to like 60%. I feel like it's a little bit higher the way I wrote the line, but still, it's not where it needs to be, which is like closer to 50% or 40%, which is down here. Right? You can see where the blue is, right? Focus on the blue. The other one that's very important is average price annual percent change. So this is not the average price. This is the percent change in price. Let's look at the 2 timelines that we talked about earlier, right? You guys remember those ones? We talked about when the stress test was added and when the rates came down during COVID, right? Which is March 2020, right? So let's take a look at that quickly. So when the stress test was added, approximately around here, again, we're focusing on the orange line, we saw property price changes of 20 to 30%. That is ridiculous. A home's price should change just slightly above inflation. So if inflation is at 2 or 3%, you should see home prices change about 4 or 5% on average, which is interesting because the average in the last 15 years here is about 5%, which makes sense. But we had 2 times where it was just ridiculous, 2 major times that were ridiculous, which is just before we had a little bit of the market was heating up, and then the government added the stress test, which is great, made it very tough for people to purchase the home. I think I might have skipped something here. So the stress test, I should explain what that is. The stress test before, when you're buying a home, if the rates on, to buy a home was, the mortgage rate was 3%, then that's where you go to the bank, they qualify you at 3%. The stress test, what it does is, they look at whatever the rate is at the bank. So let's say 3%. They'll say, okay, we're gonna stress test you to whatever the rate is plus 2%. So 5%. And I
Yeah,
believe it
that's
was
a
at,
big reason why a lot of people aren't qualifying these days is because of that stress test. So we mentioned a rate of, for example, 4.11%. You can get that rate, but to qualify, you will be qualified based on 6.11%, which is your rate plus 2%. So even though realistically you have access to 4.11%, but the qualification or the mortgage number that you qualify for will be based on 6.11%, which brought the qualification down significantly for a lot of buyers.
yeah. Now here's the interesting part. This is where the conspiracy, what a lot of people think is like, man, what was this COVID thing planned? We in Canada added the stress test in call it 2017. It's late 2016. Okay. And then 2 years later, or roughly 3 years later, in 2020, what ended up happening is the COVID happened and they lowered rates like crazy. The interest rates were dropped from 3-4% at that time to you can get rates as low as like 1.6, 1.7% during
Yeah,
COVID.
we're seeing as low as 0.99%.
Oh wow, I didn't even know that low. There you go. So we saw market heating up. They added the stress test, cool things down. It calmed down, and then right around here is what? COVID, and then we started seeing it pick up. It became abnormal, right? And then we started seeing rates in March of 2022. That's when we saw the peak, and then they started adding interest rate hikes, and then it started to come down. So a good question people keep asking me these days that I really like is, we're seeing rates come down. Why are we not seeing the market heat up quickly? It's for two reasons. Number one is it's always a lagging factor. It doesn't instantly change that. So people might be quick to stop making the purchase. So you add a stress test, boom, you don't qualify, so it comes down. Oh, you suddenly increase rates. Okay, wait, something changed. Let's wait. But to buy takes time, right? So even if people started buying, by the time you see the transactions come through, it'll take some time. Plus, people are still going to be, wait, what's going on? Is it going to drop a little bit more? Maybe they can qualify for a better rate. So the buying is going to take some time before you see it happen. The second thing is, we don't have FOMO. Here's what's interesting. And here's the part that is a little bit frustrating, but it happens. Over here, this part right here, you can see that sales to listing ratio. This is a strong seller's market. COVID time was a terrible time, technically, to buy a home because there's a lot of competition. You don't get to even see the home. Home gets put for sale and it's instantly gone. But yet people were buying. Why is that? It's not only because the interest rates were low, but also the mentality that, oh my goodness, home prices are changing by 10%, 15%, 20, 30%. If I don't get in now, I am screwed. So the FOMO added that. What's happening today? So rates are coming down, and everyone's watching. This is very key, okay? The home prices are not changing. And if you're wondering what the year-over-year number is, it went down by 1%. Okay, and we see that here, right? You can see it on the graph. This one is actually updated. For some reason, the other one, it stops at 2024. So I have to tell you what's kind of happening here. But this one here goes all the way. And the orange line, which is the average price change, it's basically zero. So it's normalizing. That part right there. So there's no FOMO. So if you guys are worried, do you need to jump ASAP right now? It might not change right now. It might change in 6 months or 3 months. But here's the key thing. Rates are coming down. And we saw when rates come down, that prices will follow eventually. So there is a lot of favorable reasons to jump in now, assuming you qualify, assuming you can afford the home, you go through the process, the mindset, and you're prepared for it. Don't just go because, you need, we sold you this, right? We don't want you to pressure that. But we want you to go through it. Here's the interesting part. Because we're not seeing prices change, that FOMO aspect of it is completely gone. I personally believe the thing that's remaining is the lagging factor. So after 3 to 6 months, we will start seeing things pick back up. Now, we're not here to sell you on it. We're not here to force you on it. There is, it's an economy. We don't miraculously know what's going to happen. We're just sharing with you the data that we see. And seeing that there is strong demand on, a squeeze on the supply side, So for folks that are wondering about pre-construction projects, you will notice that majority of the projects and even some of the builders have gone into receivership. But a lot of the projects that launch, they actually cancel if they don't get 70 to 80% sold. And that's the concern these days, is these projects are not meeting the threshold, so they're being canceled, which means we're very likely going to see a housing shortage later. If you're wondering what the government is doing about it, they're saying, we're going to give you more loans, we're going to let you build the homes. So now you're allowed to build the 4 units. Take your detached house and make it into 4 units. So they themselves realize that they're not able to build the homes, the houses, and build up the supply that's needed. So they're throwing it at the homeowners and saying, hey, you can build a secondary suite, you can build a fourplex. All semis and detached can be fourplexes in Toronto now. You don't have to get a special permit for it. So it really sucks. I think it's not the best solution the government is doing. But for you guys being potentially homeowners in the next 1 year to 5 years, keep that in mind. Okay.
Yeah. If anybody has any questions, I know it's 8 p.m., but feel free to put it in the chat. We can stay for however long as you need. Yeah.
We're summarizing everything quickly now. Any questions you have, throw them in the chat. This will be like another 2 or 3 minutes, and we should be done. What is the whole key takeaway from this whole presentation is lowering your debts, guys. Like, check your credit card, open your statements, don't be scared of them. Lower those debts as much as you can. Take advantage of the home buyer program. So don't put your money in a TFSA or just a general savings account. Put it in an RRSP, put it in an FHSA account. From those accounts, you can still invest in stocks, crypto, whatever you're into. You can do that stuff. Talk to a financial advisor. Talk to us early. We don't mind supporting. I'm not going to force you to buy a home or sell a home. And if anybody has any questions, put them in the chat. Stay away from pre-construction. Oh my goodness. Really, the reason for this is simply because the cost for pre-construction has not made sense for the last 4 or 5 years, but yet people are still buying them. It only made sense because this was happening. So the average price was increasing by like so much that you're going to make money on it anyway. It's not a good investment. If you bought any house, even a resale home, you would have made actually more money. But people were making so much money that they're like just happy about the concept. All right. Stay away from pre-construction, just period. We can actually sell pre-construction. We actually make more money on pre-construction. But I'll still say, please don't buy any pre-construction. If you really have to, let's talk first. I can explain to you the reasons why not. We'll go into more detail on a different day. And then work with professionals. The market is changing all the time. People think that you can sell a home very easy today. They'll work with anybody, and then they discover afterwards that it might not work. Some people will try to go buy a home and then discover after they maybe bought a lemon or something's wrong with it, or just simply they try to go to the first lender, their bank, and then they discover that they didn't get the best rate out there. So that's why I talk to a mortgage broker as early as possible. These are some useful links for you guys. Very, very useful. Equifax, Credit Karma. These are all great sources to check your credit for free. Will not affect your score. Our websites are here. If you need any sort of affordability calculator or updates on the mortgages and stuff, it's all here. Mudo has an app called My Mortgage Toolbox. Check it out on the App Store. Very good. And I see some questions that are coming in, so we're going to start answering these questions. Thank you for those that have stayed this long. Once again, this is recorded. We're going to put this up on YouTube and send you guys the link. We'll go over the questions. We'll probably just leave it all recorded anyway. And if you have any questions, put it in the chat, and we'll go through it. How long after reducing your debts will your credit score improve? I don't know the exact answer. I'm not sure if you know this one.
Yeah. You can see it improve as soon as 1 month, which is your score is reported each month. So depending on how much you reduce your debts, you can see the change in as low as 1 month. So I would say a couple of months, especially if it's something like credit utilization where your balance was too high. You were, for example, paying 7,000 on a 10,000 limit, but then you brought it down to 3,000. You can see the jump as soon as 1 month. We've seen it with a lot of clients. So it is a fast improvement. But if it's something severe, like, for example, a bankruptcy or a consumer proposal, these tend to take time, sometimes years. but usually we do see the score improve significantly with things such as one or two missed payments. Those types of situations are easily manageable.
Excellent. One actually, you guys can put more questions down in the chat, but for now, since we're not seeing many, is I want you guys to check your credit, especially using this. Any of these sources is fine. If you find anything that's a discrepancy, doesn't make sense. It actually happened to myself where I found a ticket, I guess because I have a common name. Somebody had a traffic ticket that went to collections. And if you use the Trends Union website, you can actually dispute it for free. And they have 30 days to reply back to you and prove that it's you and you're at fault. And if they don't, or they don't hear back, it actually gets canceled and waived off. So that takes a little bit longer. I think it took me about 60 days, if not a little bit longer. But it's a very useful tool. So check it just to make sure that everything is good on your part. What I'm going to do, just to kind of make it easier, is I'm going to stop recording. And what I'm going to do is allow everybody to just unmute themselves if they want to and talk. Where is it here? I see some questions, some raised hands, that's why. If a family member gifts you a down payment for a house, does it stay in your, what is it? Does it need to stay in your account for 90 days as well?
Yeah, that's a great question. Very, very specific. And it's a good one because usually, just to give people an idea, usually when it comes to your down payment, the bank wants to see the amount sitting in your account for at least 90 days. So anything that's coming from an external source needs to be verified. If it's coming from a family member as a gift, there is an exception. So if it's coming from a family member, it doesn't need to be there for 90 days. So it could be there for only 30 days. As long as we can verify that it's coming from a family member, they sign a gift letter, then it's okay. You don't need to wait the 90 days. But if it's coming, for example, from a friend or any other source, then you won't be able to use it. Sometimes we see people that get transfers from friends, they're not family members, then we have to actually use that amount as a loan in your application, which means it brings down your qualification. So it's always important to ask your mortgage broker what to do before you start moving money around and have it affect your situation. But it's a great question.
Okay, thank you so much for answering it. I just wanted to just quickly verify. One, you need to prove that it's a family member. So like you need to provide identification with the payment.
Not in that